All right, welcome everybody. Keith Young, Sunbelt Business Brokers, and you're welcome to turn your sweat equity into enhanced company value. First, I'd like to kind of see who we have in the room here today. How many of you are business owners? Raise your hand. Partners? Okay, business owners. Of the business owners, which is everybody, how many of you are involved in the day-to-day sales, estimating, operations, or management in some capacity?
How about all?
All of the above? Okay, well, that's not unusual, and definitely, whatever your role is, my aim for the session today is that you'll walk away with some useful tips and information that'll help you build enhance the value of your business. Share a little bit about me so you understand the perspective I'm coming from. I grew up in Houston, joined the Navy almost out of high school after my first year of college, cryptologic technician, and served 4 years overseas. Came back, finished my degree at the University of Texas, and got married. We've been married now for 27 years. We've got 2 boys. They're 17 and 14. I've had a pretty unique career. After getting out of the Navy, I was in technology sales. Then I was in water and wastewater treatment equipment manufacturing. Moved back into technology sales for software, and got my MBA while I was working at a software company. And I got basically laid off right before the recession. And I said, you know what? Hey, why don't I use this as an opportunity to go start my own business? I just didn't know what I wanted to do, so I looked around, and I bought into a home and commercial service franchise. Started it up, grew it, sold the business after 10 years, and then I did the same thing in the flooring business. And you see me on the top right there during COVID with my mask on, giving a little piece of woodwork that I created to a customer that referred me to a nice large project. But you may agree, one of the best things about being a business owner is my ability to be there for the things that matter, be there with my family, whether it be being an assistant scoutmaster for my boys' scout troop, be the soccer coach of their soccer team when they were littler, drop off, pick up. That's one of the best things about being a business owner, is having that freedom. And today we're going to discuss a few key concepts that will help you enhance the value of your business. And it's more the transferable value. And so what we're going to talk about today will hopefully give you some thoughts and things you can do and take back. But having started and sold my own businesses and worked with clients who we've helped sell their businesses, it's definitely allowed me to see the result of building that transferable value and how it allows owners to exit if and when they want to. In addition to walking away with the knowledge and information, I'm hopeful to give you some ideas and maybe even some plans for things you can do to build a 12-month action plan that will allow you to exit when it's your time, when you're ready, and not just for the blood, maybe for the blood, sweat, and tears you've invested in the business. As business owners, we're known for working really hard, doing what it takes to get the job done, long hours, whatever it takes to win the work and manage your folks. And that's commonly referred to as sweat equity. I looked up a good quote for sweat equity. Mark Cuban says, "Sweat equity is the most valuable equity there is. Know your business and industry better than anyone else in the world. Love what you do or don't do it." And while I cannot disagree with that statement, what I've seen as a business broker is that sweat equity does not always translate into transferable business value. Now let's dig deeper into the difference between sweat equity and transferable value. So, oh gosh, that is not a very good color. Can y'all see on the buyer side?
No.
Okay. All right, not enough power on that projector. So I'll go down it. Basically, this is thinking about things from the perspective of the owner of the business versus the buyer of the business. So the the business is $3 million in annual sales, and the owner is very proud of it. I built this, but the buyer is thinking, what's the quality? What's the profit margin? What is the cash flow bottom line of the business? I'm not going to read all of them, but basically, when you feel good about what you're doing as an owner, involved in everything, knowing everyone, all your staff, your customers, being deeply involved in the business, as a positive, the buyer looks at that as a risk, as what happens, what can function without you in the business. So the same business where the owner's thinking, well, this has got to be worth 3 or 4 million, the buyer might offer $1.5 million because they are trying to adjust their offer to account for the risk of what happens when you're no longer in the business. So they don't pay for how hard you work, the sweat equity, they pay for what works without you, the transferable value. This is a little graphic on the buyer universe that we look at when it comes to selling your business to a third party. So this is not if you're selling it to family, and this is not if you're selling it to management or employees. So when you look at the buyer universe, the type of buyer determines just how much they could pay for the business. And so if you look at the outside ring, thinking like an archery target, and you can't, I don't know if y'all can read the white text on that light gray background, but at the furthest ring out is an asset or liquidation value buyer. They're buying the stuff, right? All your business might be worth is the value of your equipment, furniture, fixtures, and maybe your inventory, which is usually going to be the lowest value of the business. And so most people hopefully don't have to sell their business for asset value. The next level up would be an industry competitor. They're already in the business. They know what they're doing. They don't maybe need your systems and processes. They might just want your customers, and they might want maybe some of your employees or staff to help them deliver service. But they're not going to really pay much of a high multiple because they're already in the business. And the next level up would be a financial buyer. At Sunbelt, we most frequently deal with financial buyers. They're buyers that are buying a business for the cash flow. They're valuing the business on the cash flow, and they're usually using some form of small business administration financing to accomplish that. They might be coming out of corporate America to buy a business, or they might be an entrepreneur that sold a business and looking for the next business to buy. But during that financing, the bank is going to scrutinize the financials and make sure that the buyer can afford to buy the business and still have some money left over after debt service. The next level of buyer would be what's called a family office. Some people aren't familiar with what that is. Essentially, that is a high net worth family who is investing their own assets. Maybe they've had a major exit, maybe they just have family money, but they buy businesses versus investing in the stock market with all their money. And then because they're bringing a lot of their own money to the table, they can afford to pay more, and they can afford to take a longer term view because they're not necessarily depending on the cash flow from that one business all at one time. Whereas a financial buyer, a lot of times they're buying that business and that's their only business. And then at the very center ring, you've got both strategic and private equity. Private equity, they're swinging for the fences. Their goal is to buy a business, 10 exit in 5 years, and then exit the business for a big cash payout. They have some of their own money they bring to the table, but generally they're having investors and debt involved, highly leveraged a lot of times too, but they're swinging for the fences. The other highest and best buyer is strategic. Those are great buyers because maybe they have a complementary business. They're in plumbing, they're in electrical, they want an HVAC company because you have different customers, different services. So the value of these two businesses together is more than they are separately because now all of a sudden you have other things to sell, other people to sell them to, and even staff to grow the business. So just because they're able to pay those kind of multiples doesn't mean that they will pay those multiples. For example, private equity. A couple of years ago, we sold 2 different contractor businesses at the same time to a private equity group. They merged them together. They consolidated the operations at one location, so they saved some money. But now all of a sudden they had a service delivery team that didn't have enough customers to go and service. So another one of our clients had an owner-operator business with one technician, and he was looking at, well, gosh, he was most of the business, and we connected them together. They were able to acquire his business, and really what they wanted was more customers. So they're not going to pay a 6 or 10x multiple for that, but it was great for our client because one of the few options he had at that point was to just shut the business down. So he was able to cash out on the business, move along, but this is a little more information about what types of buyers out there that we deal with. So the next eye chart here is something I do when I first engage with new clients for a market pricing analysis. I get to understand a little bit about their business, and I want to go out there and look in the market and see what similar types of businesses has sold for. So in this, on the left, the vertical is the price of the business, total selling price of the business. The horizontal is their operating cash profit, their EBITDA. And as you can see, the more profit they have, the trend line goes up. So this represents only contractors, plumbing and HVAC contractors with sales of 1 to 5 million that are profitable. So I didn't include any businesses in here that were not profitable. And then also it was dates, it was 3 years plus to March 15th of this year. So that came up with 172 sales transactions. And I wanted to highlight in particular, you can see obviously some are above and some are below the line, but if you look at the $500,000 EBITDA level right there where I put the little blue box around it, you can see on the lower end, a couple of those businesses were around 1.25 million, and the one at the top is about 5 million. So what's the difference between the dots at the bottom of the box and the dots at the top of the box? And I would argue that has a lot to do with transferable business value. So this is all driven by some key value drivers. Now, keep in mind, these are not the only value drivers, but they're ones that we often see on the top of our buyers list. They're the things that they care about the most. Recurring revenue. How many customers do you have on these maintenance contracts? And what are their renewal rates? Are you able to use that work to stay busy in times when you would otherwise be paying people to stand there? Owner independence. How much of the business works without you being there in the business to make it work? And so the buyers are buying a system, not just you to be there. And then finally, documented systems and processes. It really helps when you have your ducks in a row to move through the sales process quickly, because there's a saying that says time kills deals. I hate the word deals, but it's true. The longer it takes from when you sign up to sell your business to some person and the transaction actually happens, when they're performing their due diligence, they're digging into everything, the more time it takes you to put that together and get it to them, if you don't have it ready in advance, the less likelihood things are actually going to come to a close with the sale transaction. These are not easy things to do, right? I've been a contractor myself. I lived in that world for a dozen years. And I know it's easy to sit here and say this, to do this, but it really makes a big difference, we've seen, in the outcome for our clients when they're looking to sell their business. So let me see a show of hands. Which of you feel like I'm going to ask you which one is the most frequent concern? Recurring revenue, raise your hand. Owner independence, and documented systems and processes. Yeah, all the above. Owner independence is definitely the one that we see as being the most challenging. It really trips up HVAC owners because a lot of times they are the business. You started as a technician to get your license, maybe working for somebody else, and you broke off on your own. You have the ability to do what your team needs to do. You can go climb in that attic and fix that system. But you've moved up, now you're the business owner. How do you extrapolate yourself from that is a real challenge. So I'd like to take a moment here and do a quick survey. So I'd like you to answer these 4 questions, and I'd like you to be brutally honest, meaning really think about the answers. And I'd like you to put a 0 to 10 on each of those questions. And keep in mind, I would like you to not pick a 5. To me, there's really no such thing as average. You're either below average or above average. So each of these, I'd like to give you 30 to 45 seconds. Think about the questions, put a number on it, and add them up. And then we'll talk about it in the next slide. Everybody got a number? By the way, I'm not going to ask you to tell me your number. So.
I was going to ask you, 0 is technically a number, right? Isn't it black numbers?
All right, I'll move to the next slide. So here is the scoring key, and if you scored a 32 or higher, congratulations. You are at a low dependency, owner dependency in your business, which usually it's taken in context with the other value drivers, but that is definitely something that leads to increased multiples. 17 to 31 is a moderate dependency, and then 0 to 16, lower EBITDA multiples at best. And I say at best because it may be that if the owner is the business, it may not be possible for us to help them sell the business if they are so much the business. But consider that for every 4 points on this little scale, it can be worth $100 or hundreds of thousands of dollars on your business value at sale. So we do have a full 10-question survey. So if you'd like to pick it up when we're done, it's available there for you to pick up. And then, of course, I'm also happy to provide the slides. Just drop a card or leave me your email, and I'd be happy to provide those as well. So before we start talking about how to move from where you are today to tomorrow, let's do a quick reality check. So most business owners plan to sell someday. They delay the planning, and then something happens. They have a health situation, they have a family situation, so they're just extremely burned out and like, hey, I can't do this anymore. But they get to that point where they get to that health situation, what have you. They try to fix their business in a short period of time, and it might make a little difference, but mostly buyers can see when they've tried to make some major changes quickly. We did a survey of business brokers, and just to get an idea, and the consensus was about a quarter of the businesses going to market are going because of burnout. Another 10 to 15% pushed out by health or family issues. So I can give you one example of a client I was working with. We were working with a buyer who we were under contract with, and during the due diligence period, the business took a decline in revenue and a decline in profit. And the buyer called a meeting with me and the client, and we sat down, and just about the first thing out of my client's mouth was, I just don't feel the love of this business anymore. And so at that point, I was like, oh boy, really? Fortunately, that buyer really wanted that business. And so we ended up finishing the purchase transaction, but it may have impacted the price of the business just a little bit. But we were able to actually help make it, help get it across the goal line, let's say. But in the situation you're looking at there, okay. This can make a huge difference though, because if you've done what it takes to improve the value drivers of the business, you take a business that's selling at a minimum multiple, let's say of a 2.5 million exit versus 3+ million exit. And even if you're not planning to sell, this is going to create a more profitable business, a more enjoyable business to operate as well. So, we like to think about this exit planning is just good business strategy. When you're able to exit on your terms, you're going to get a better outcome. So this is a lot of stuff here, right? What I'm hoping is, and each business is different. What you need to do in your business is going to be completely different. I've tried to categorize this into 4 different categories. And usually it's going to work from left to right, depending on where you are with the different value drivers. But these are the things that we've seen people do that have made a big difference in their ability to have transferable business value. Starting out of the gate, you're going to look at the value drivers and assess where you are. Figure out anything that's keeping you, restrainers would be things keeping you from being able to make these improvements. Maybe you're out in the field all the time, or you're having to oversee things personally that doesn't give you enough time to do this. Establish your key performance indicators. and put a system in place that allows you to keep those in mind. Clean up your financials. One of the biggest things we do as business brokers is we make adjustments to people's profit and loss to try to account for what we call discretionary expenses. My strong recommendation is that you take all your personal expenses off the business, and we don't have to do that, because what happens is when we take a business to be sold to a bank, so they do the underwriting, which is where the money is coming from, if there are too many of these add-backs, they start to really have trouble being able to finance the deal. So you're running personal expenses through the business to save money on taxes, where you could be getting a 3, 4, 5x multiple. You're trying to save a little bit of money on that income and missing out on a huge upside. So we strongly recommend that you move all your personal expenses off of your company profit and loss. Also establish, yes sir?
How long do you need that clean? Is it a year or is it 2?
We usually do a 3-year look back in year to date. So it's definitely a good period to establish that trend over
Chips.
time.
Okay, company vote.
No, I've talked to business owners, and you know, one contractor was telling me how in the slow season he had his crews go out and help him build his house. And I'm like, ooh, that's going to be a tough one to add back. So, you know, great benefit, but when it comes time to sell, that's going to be a real challenge to stand up. Recurring revenue, that's definitely one where the more you can work on that moves the lever up a lot. And putting incentives and ways for your staff to be incentivized to support those goals. And then also combining that with soliciting customer feedback to really understand what experience they're getting with your service techs. Investing in software technology upgrades. You don't have to build something from scratch. There's a lot of commercially available software packages out there. Some are expensive, but then again, if you keep in mind how having that intelligence, the financial and operational intelligence in your business translates to increased value, all of a sudden that expensive price tag, if you're using it, doesn't look quite so expensive. Management depth, that's where you really, and I would say that top bullet, assess your current management strengths and development needs. I would say engage an outside resource to help with that. That is usually not something you want to try to do in-house. But it's huge to make sure you've got the right people on the bus in the right positions, and you've got areas where you can help them be better. Promote and hire to fill gaps and take over your responsibilities. I usually tell people, let's say you're an owner, you consider yourself maybe $100, $200 an hour employee of your business. If you're doing tasks that you could pay somebody $10, $15, $20 an hour to do, don't. Stop right now, move them off your plate, and make sure you can get as much of those things off your plate. Delegate some of those key functions, and then take a 2-3 day vacation, see what happens. With these improvements you've made, are you able to break away with zero communication and the business keeps running without you, or not? Maybe you see, but this is one good way to find out. Engaging your staff with areas to improve and putting those things in place. And then big thing, communication. Proactively communicating with your customers when there are changes. Hey, John has taken over this for me. He's going to be your main point of contact, not somebody finding that out after the fact when they try to call you and say, oh wait, call John. And then finally, document and decide. Really documenting those processes, and a lot of those software packages will help with that. Consolidate and organize all relevant documents. I'm talking about everything that could be needed in a transition of a business, from your corporate formation documents to your insurance policies to your profit and loss statements to everything, tax return documents, everything consolidated, organized, and accessible by somebody who's outside of just you. Because who knows when you'll need those, but the more you have them consolidated, organized, and available, the easier it is when it gets time, or should something happen untimely that things need to be taken care of, everything is in one place. Create your 1 to 2 page value story. If you started out at the baseline and cleanup, and I highly recommend at the start you get a business valuation or market pricing analysis of some sort, so you set that point in time. But at the end of that 12-month period, look back, think about how is my business more valuable than just any other contractor's business in my space? And what have I done, my story, over the last 12 months to improve that value? What have I put in place? Key piece of the puzzle there. And then, most importantly, the very last bullet. Make the decision, are you going to keep the business? Are you going to sell it? Or are you going to expand? Either organically, or are you going to acquire another business? All the things you put in place in those first 3 columns are going to enable you to take on another business, say, who hasn't done those things, but you're going to buy them at that 2 to 3x multiple, and then bring them into your business where you've got your value drivers in place, systems, processes, all those things in place. You're going to buy a business at a 2 or 3x multiple, and then you're going to sell at your 4 to 5x multiple or better. So it's a great way to use this not only to improve your business, but to grow through acquisition. So I'd like to present a famous quote from a very famous business buyer. Price is what you pay, value is what you get. And I'd like to reframe that just a little bit, and kind of like the field of dreams. If you build the transferable value in your business, the buyer will come and pay for it. So you've spent years building your business, building it through sweat equity, and hopefully through building transferable value. Make the effort. It will make hundreds of thousands, if not millions of dollars of difference in your pocket. And in the meantime, you'll have a more enjoyable business to run, more profitable. It can dramatically change your life. So recall the initial question I asked: how can you enhance the transferable value of your business? Hopefully, by following some of the strategies on the roadmap, you can use those to enhance your business and get to that place where you have the options to exit when you want to, or if, and how. So next steps, take the full owner independent survey. Really start thinking about and writing down, building your team. You need a CPA, you need an attorney, and you need a financial planner to really help you build all 3 sides of the stool, 3 legs of the stool. We talk about as a business owner, most are just focused on the business. You really need to focus on the personal and your financial, because maybe you sell your business for $3, $4, $5 million. Unfortunately, you don't keep all of that because there are fees and taxes associated too. And there are ways you can structure your business, take advantage of tax law that will allow you to keep more of it versus having to give more away in the form of taxes. And then finally, if it's not with Sunbelt, schedule a market pricing analysis with somebody so you can set that baseline and really show the investment of time and money that it's going to take, but the value you've created by investing that over the next 12 months. So you're not getting ready to sell, you're building a company with greater value to pass on to family or others. So that is it. Just appreciate your time, and anybody have any questions?